Question 1. Topic: Policy structure and features. A policyholder is looking to purchase a long-term care (LTC) insurance policy that will help protect their benefits against inflation. Which of the following policy features would best address their concern? A. Waiver of premium provision. B. Inflation protection rider. C. Guaranteed renewability clause. D. Shared care rider. Answer: B. Inflation protection rider. Explanation: an inflation protection rider adjusts the policy's benefits over time to account for rising costs of care, which helps preserve the policyholder's purchasing power in the face of inflation. This rider can provide simple or compound increases based on the terms selected. The other options, while important features, do not address inflation directly. Waiver of premium provision allows the policyholder to stop paying premiums when they are receiving LTC benefits but does not protect against inflation. Guaranteed renewability clause ensures the policy remains active as long as premiums are paid, but it does not adjust for inflation. Shared care rider allows couples to share their total pool of benefits, which helps with resource management but not inflation. Question 2. Topic: Coordination of benefits with government programs. Which of the following is not true regarding the interaction between Medicaid and long-term care (LTC) insurance in Maine? A. Medicaid will only provide benefits after the policyholder has exhausted their LTC insurance benefits. B. LTC insurance can help protect assets through Maine's long-term care partnership program. C. Medicaid will cover all types of long-term care services regardless of the policyholder's resources. D. A policyholder may need to spend down their assets to qualify for Medicaid after using their LTC insurance benefits. Answer: C. Medicaid will cover all types of long-term care services regardless of the policyholder's resources. Explanation: Option C is incorrect because Medicaid is a means-tested program, meaning that a person must meet certain financial requirements, including asset and income limits, to qualify for benefits. Medicaid will only step in to cover long-term care costs after the individual has spent down their resources to meet eligibility requirements. Option A is true. Medicaid typically steps in only after LTC insurance benefits are fully utilized. Option B is also true. The Maine Long-Term Care Partnership Program allows policyholders to protect assets that would otherwise need to be spent down before qualifying for Medicaid. Option D is true. Many people need to spend down assets to become eligible for Medicaid coverage even after their LTC insurance benefits are exhausted. Question 3. Scenario-based question. Topic: Exclusions and limitations. Mr. Thompson, a 67-year-old retiree, has recently been diagnosed with Parkinson's disease. He purchased a long-term care (LTC) insurance policy 3 years ago and is concerned about when he might become eligible for benefits. His policy includes a 90-day elimination period and coverage for cognitive impairments. However, it also has an exclusion for pre-existing conditions not disclosed at the time of application. Given this information, under what conditions could Mr. Thompson be eligible for benefits? A. Mr. Thompson will be eligible for benefits immediately because he has a cognitive impairment. B. Mr. Thompson will not be eligible for benefits because Parkinson's disease was not disclosed at the time of his application. C. Mr. Thompson will become eligible after the 90-day elimination period, provided his condition is not classified as a pre-existing condition under his policy. D. Mr. Thompson will only be eligible for benefits if he develops an unrelated health condition. Answer: C. Mr. Thompson will become eligible after the 90-day elimination period, provided his condition is not classified as a pre-existing condition under his policy. Explanation: in this scenario, Mr. Thompson's eligibility for benefits depends on whether his Parkinson's disease is considered a pre-existing condition under the terms of his policy. Since his policy includes coverage for cognitive impairments and has a 90-day elimination period, he would need to wait for that period to pass before receiving benefits. If Parkinson's was not classified as a pre-existing condition, or if it was fully disclosed during underwriting, he could receive benefits after the elimination period. Option A is incorrect because Mr. Thompson must still wait out the elimination period even if he meets the cognitive impairment trigger. Option B would only be true if Parkinson's was determined to be a pre-existing condition that was not disclosed, which the scenario does not confirm. Option D is incorrect because LTC policies typically cover conditions like Parkinson's, assuming they are not excluded or undisclosed pre-existing conditions. Question 4. Topic: Eligibility and benefit triggers. A policyholder's long-term care (LTC) insurance policy has a benefit trigger based on their inability to perform 2 activities of daily living adults. Which of the following scenarios would most likely meet the benefit trigger? A. The policyholder is unable to drive and needs help managing their medications. B. The policyholder needs assistance with dressing and bathing. C. The policyholder has difficulty walking and managing their finances. D. The policyholder requires help with cooking and shopping. Answer: B. The policyholder needs assistance with dressing and bathing. Explanation: LTC policies often use activities of daily living adults as a measure to trigger benefits. Common ADLS include dressing, bathing, eating, toileting, transferring, and continence. Needing help with two or more of these activities typically qualifies a policyholder for benefits. Option B includes 2A DLS dressing and bathing, so it meets the trigger. The other options do not reference at least two adults. Option A mentions driving and medication management, neither of which are considered adults. Option C includes walking, a mobility issue, but not specifically an adult, and financial management, not an adult. Option D includes activities related to independent living, but not adults. Question 5, scenario-based question topic, claims management and appeals. MS Daniels filed a claim with her long-term care LTC insurance company for benefits related to in-home care. The insurer denied her claim, stating that she did not provide adequate documentation proving her need for assistance with activities of daily living adults. MS Daniels feels that the insurer's decision was unfair and would like to appeal the denial. What should MS Daniels do to strengthen her appeal? A. MS Daniels should provide a doctor's certification and a plan of care that outlines her need for assistance with adults. B. MS Daniels should hire a lawyer to file a lawsuit against the insurance company immediately. C. MS Daniels should accept the insurer's decision, as appeals are rarely successful. D. MS Daniels should submit a new claim with additional medical information without going through the appeals process. Answer A. MS Daniels should provide a doctor's certification and a plan of care that outlines her need for assistance with adults. Explanation: to appeal a denied claim, policyholders like MS Daniels should provide additional medical documentation, including a doctor's certification and a plan of care that clearly outlines the need for assistance with adults, as these are often critical to proving eligibility for LTC benefits. Option A is correct because it directly addresses the insurer's concern about insufficient documentation. Option B is premature. Lawsuits are typically a last resort, only after exhausting the appeals process. Option C is incorrect because appeals can be successful if adequate evidence is provided. Option D suggests bypassing the formal appeals process, which could delay resolution and weaken the policyholder's position. Question 6. Topic: exclusions and limitations. Which of the following conditions is most likely to be excluded from coverage under a long-term care LTC insurance policy? A. Alzheimer's disease diagnosed after policy issuance. B. Pre-existing conditions not disclosed during the application process. C. Assistance with bathing and dressing due to advanced age. D. In-home care services provided by a licensed nurse. Answer: B. Pre-existing conditions not disclosed during the application process. Explanation: many LTC insurance policies exclude pre-existing conditions that were not disclosed during the application process, as this allows insurers to mitigate risk based on known medical histories. If a policyholder fails to disclose a condition, the insurer may deny coverage related to that condition. Option B is correct because non-disclosure of pre-existing conditions is a common exclusion. Option A is incorrect because conditions diagnosed after policy issuance, like Alzheimer's, are typically covered. Option C is incorrect because needing assistance with a DLS like bathing and dressing is precisely what LTC policies are designed to cover. Option D is incorrect because in-home care provided by a licensed nurse is generally covered under LTC policies. Question 7. Topic: long-term care insurance underwriting. Which of the following factors is least likely to affect the premium of a long-term care LTC insurance policy? A. The policyholder's age at the time of purchase. B. The selection of a reimbursement versus indemnity plan. C. The number of activities of daily living adults the policyholder requires assistance with. D. The inclusion of an inflation protection rider. Answer: C. The number of activities of daily living adults the policyholder requires assistance with. Explanation: the number of a DLR policyholder needs help with is used to determine eligibility for benefits, not the premium cost. Premiums are typically based on factors such as age, policy options, and additional features like inflation protection. Option A is incorrect because age is a significant factor in determining premiums. The younger you are when purchasing a policy, the lower the premium. Option B is incorrect because choosing between a reimbursement or indemnity plan impacts premium cost. Option D is incorrect because adding an inflation protection rider increases the premium to account for future benefit adjustments. Question 8. Topic: Premiums and payment structures. Which of the following statements about premium payment options in long-term care (LTC) insurance is correct? A. Premiums are only due while receiving benefits under the policy. B. A single pay option allows the policyholder to pay all premiums upfront, often at a discount. C. Lifetime pay premiums are adjusted every year based on inflation. D. Limited pay options are typically more expensive than lifetime pay options due to reduced flexibility. Answer: B. A single pay option allows the policyholder to pay all premiums upfront, often at a discount. Explanation: a single pay option allows the policyholder to pay all premiums in a lump sum, typically receiving a discount for doing so. This option can be advantageous for those with the financial resources to pay upfront and avoid future premium increases. Option A is incorrect because premiums are usually due until the policyholder begins receiving benefits or unless a waiver of premium applies. Option C is incorrect because lifetime pay options typically have level premiums that do not adjust annually based on inflation. Option D is incorrect because limited pay options are often more expensive upfront but provide the benefit of paying off the policy faster. Question 9. Scenario-based question. Topic: Maine Long-Term Care Partnership Program. Mr. Rivera, a 68-year-old Maine resident, has a long-term care (LTC) insurance policy that qualifies under the Maine Long-Term Care Partnership Program. He's concerned about protecting his assets while also qualifying for Medicaid should his LTC insurance benefits run out. How does his participation in the partnership program benefit him? A. His LTC insurance benefits will be fully reimbursed by Medicaid once exhausted. B. He will be able to protect an equivalent amount of assets to the benefits paid out by his LTC insurance. C. He will qualify for Medicaid immediately without needing to meet any asset limits. D. The partnership program ensures that his premiums will never increase. Answer: B. He will be able to protect an equivalent amount of assets to the benefits paid out by his LTC insurance. Explanation: the Maine Long-Term Care Partnership Program allows policyholders like Mr. Rivera to protect assets equal to the benefits paid by their LTC insurance when determining Medicaid eligibility. This means if his policy pays out $200,000 in benefits, he can protect $200,000 in assets from Medicaid's asset limits. Option A is incorrect because Medicaid does not reimburse LTC insurance benefits. Option C is incorrect because Medicaid still requires asset and income limits, but the partnership program allows protected assets. Option D is incorrect because premium stability is not guaranteed under the partnership program. Question 10. Topic: Tax implications of long-term care insurance. Which of the following is true about the tax treatment of long-term care (LTC) insurance premiums? A. LTC insurance premiums are always fully tax-deductible regardless of policy type. B. Only premiums for tax-qualified LTC insurance policies may be partially deductible as medical expenses. C. All LTC policyholders can deduct their premiums from their Maine state income taxes. D. LTC insurance premiums are only deductible if the policyholder has not claimed any other medical deductions. Answer: B. Only premiums for tax-qualified LTC insurance policies may be partially deductible as medical expenses. Explanation: tax-qualified long-term care insurance policies are eligible for partial deductions as medical expenses under federal law, subject to certain limits based on the policyholder's age and total medical expenses. Non-tax qualified policies do not offer this benefit. Option A is incorrect because not all premiums are fully tax-deductible and only tax-qualified policies may offer deductions. Option C is incorrect because deductions vary by state and individual tax situation. Option D is incorrect because LTC premiums can be deducted alongside other medical expenses as long as total medical expenses exceed a certain percentage of. Question 11. Topic: Benefit periods. Which of the following statements about benefit periods in long-term care (LTC) insurance is accurate? A. Benefit periods are the maximum time an insurer will pay for long-term care services. B. Benefit periods can only be chosen at the time of policy purchase and cannot be changed later. C. The longer the benefit period selected, the lower the premium. D. All LTC insurance policies have a standard benefit period of 5 years. Answer A. Benefit periods are the maximum time an insurer will pay for long-term care services. Explanation: the benefit period in an LTC insurance policy specifies the maximum duration for which benefits will be paid. It can vary from a few years to a lifetime, depending on the policy. Option B is incorrect as some policies allow for adjustments in benefit periods. Option C is misleading. Typically, a longer benefit period results in a higher premium due to increased coverage. Option D is incorrect because benefit periods can vary widely by policy. Question 12. Scenario-based question. Topic: Inflation protection. Mr. Johnson purchased a long-term care (LTC) insurance policy without inflation protection. At age 75, he realizes that the daily benefit amount will not cover the rising costs of care. What impact does his lack of inflation protection have on his coverage? A. His policy will automatically adjust the daily benefit to current rates. B. He may face a significant shortfall in coverage as care costs increase. C. His premiums will be reduced because he did not select inflation protection. D. He can still purchase inflation protection at any time after policy issuance. Answer: B. You may face a significant shortfall in coverage as care costs increase. Explanation: without inflation protection, the daily benefit amount remains static, which can lead to inadequate coverage as the costs of long-term care typically rise over time. Option A is incorrect because benefits do not automatically adjust without an inflation rider. Option C is misleading. Premiums are generally higher when inflation protection is included, not lower when excluded. Option D is incorrect. Most insurers do not allow for the addition of inflation protection after the policy has been issued. Question 13. Topic: State regulations. Which of the following is a common requirement for long-term care (LTC) insurance policies in many states? A. All policies must provide unlimited coverage for home health care services. B. Policies must offer a free look period, allowing policyholders to cancel within a specific time frame. C. Insurers are not required to offer a guaranteed renewable option for policies. D. Policies must cover all services related to long-term care without any exclusions. Answer: B. Policies must offer a free look period, allowing policyholders to cancel within a specific time frame. Explanation: many states mandate a free look period during which policyholders can review their LTC insurance policy and cancel it for a full refund. Option A is incorrect as policies typically do not have to provide unlimited coverage. Option C is misleading. Guaranteed renewal options are commonly required in state regulations. Option D is incorrect. Most policies contain exclusions and limitations. Question 14. Scenario-based question. Topic: Provider networks. Mrs. Taylor has a long-term care (LTC) insurance policy that specifies care must be provided by approved facilities or providers. If she wishes to receive care from a non-approved provider, what will likely happen? A. Her policy will pay a partial benefit for care received from the non-approved provider. B. She will receive full benefits without any issues. C. She may not receive any benefits for care received from the non-approved provider. D. She can change her policy to include the non-approved provider at any time. Answer: C. She may not receive any benefits for care received from the non-approved provider. Explanation: LTC policies often specify approved providers and facilities to control costs and ensure quality care. If Mrs. Taylor chooses a non-approved provider, her policy may not cover any related expenses. Option A is incorrect. Coverage typically does not extend to non-approved providers. Option B is incorrect. Benefits are usually contingent upon using approved providers. Option D is misleading. Policy changes regarding provider networks often have limitations and restrictions. Question 15. Topic: Underwriting guidelines. What is a common underwriting factor that insurers consider when issuing a long-term care (LTC) insurance policy? A. The policyholder's income level. B. The policyholder's family medical history. C. The policyholder's credit score. D. The policyholder's employment status. Answer: B. The policyholder's family medical history. Explanation: insurers typically evaluate a policyholder's family medical history as it can indicate potential hereditary health risks that might affect future long-term care needs. Option A is incorrect as income is not a direct factor in underwriting for LTC policies. Option C is misleading. While some insurers may consider credit scores for other types of insurance, it's not common for LTC. Option D is not typically a determining factor in the underwriting process for LTC insurance. Question 16. Topic: Types of coverage. Which of the following types of long-term care (LTC) insurance coverage provides benefits for care received in a variety of settings, including home care, assisted living, and nursing facilities? A. Traditional LTC insurance. B. Short-term care insurance. C. Critical illness insurance. D. Medicare supplement insurance. Answer A. Traditional LTC insurance. Explanation: traditional long-term care insurance is designed to provide comprehensive coverage for a range of care settings including home care, assisted living, and nursing facilities. Option B is incorrect as short-term care insurance is typically for brief stays and does not provide the same breadth of coverage. Option C focuses on specific illnesses and does not cover long-term care needs. Option D is designed to supplement Medicare coverage and does not primarily cover long-term care. Question 17, scenario-based question, topic, policy cancellation. Mr. Clark's long-term care (LTC) insurance policy states that it can be cancelled by the insurer for non-payment of premiums. If Mr. Clark is unable to pay his premium due to financial hardship, what should he consider doing before cancellation occurs? A. Wait until the policy is cancelled to apply for a state-sponsored program. B. Contact the insurance company to discuss possible payment options or a grace period. C. Assume that the policy will remain active regardless of premium payment. D. Ignore the situation as cancellation is unlikely to happen. Answer. B. Contact the insurance company to discuss possible payment options or a grace period. Explanation. It's important for Mr. Clark to communicate with his insurer to explore options, such as a grace period for premium payments or possible payment plans. Insurers may offer flexibility to avoid cancellation. Option A is incorrect as applying after cancellation may leave him without coverage. Option C is misleading. Failure to pay premiums can lead to policy cancellation. Option D is incorrect at assuming cancellation is unlikely as risky, especially during financial hardship. Question 18. Topic: Reinstatement provisions. What is typically true about reinstatement provisions in long-term care (LTC) insurance policies? A. Policies usually do not offer any reinstatement options after cancellation. B. Most insurers require policyholders to provide proof of insurability for reinstatement. C. Reinstatement provisions are standard in all LTC insurance policies. D. The reinstatement process can vary by insurer and policy. Answer D. The reinstatement process can vary by insurer and policy. Explanation. Reinstatement provisions can differ widely between insurance companies and individual policies, thus it's essential for policyholders to review their specific terms. Option A is incorrect as many policies do allow for reinstatement under certain conditions. Option B is not universally true. Some policies may not require proof of insurability for reinstatement. Option C is misleading because not all LTC policies include reinstatement provisions. Question 19. Scenario-based question. Topic: Care coordination services. Mrs. Smith has a long-term care (LTC) insurance policy that includes care coordination services. After her recent hospitalization, she requires assistance in planning her post-discharge care. How can the care coordination services in her policy help her? A. They will directly pay for all her medical expenses related to her hospitalization. B. They will provide her with referrals to appropriate care providers and assist in creating a care plan. C. They will determine if she qualifies for Medicaid coverage. D. They will send a nurse to her home every day to provide care. Answer. B. They will provide her with referrals to appropriate care providers and assist in creating a care plan. Explanation. Care coordination services aim to help policyholders like Mrs. Smith navigate their post-care needs by connecting them with providers and developing an individualized care plan. Question 20. Topic: Waiver of premium. What is the purpose of the waiver of premium provision in a long-term care (LTC) insurance policy? A. It allows policyholders to stop paying premiums once they turn 65. B. It suspends premium payments while the policyholder is receiving benefits. C. It eliminates the need to pay premiums for the first year after the policy is purchased. D. It waives premium payments if the policyholder is unable to pay due to financial hardship. Answer. B. It suspends premium payments while the policyholder is receiving benefits. Explanation. A waiver of premium provision allows the policyholder to stop paying premiums while they are receiving long-term care benefits. This feature helps alleviate the financial burden during the period when care is being utilized. Option A is incorrect because the waiver of premium is not age-based. Option C is incorrect as it does not refer to the initial year of the policy. Option D is misleading because the waiver is not typically linked to financial hardship but rather to receiving care. Question 21. Scenario-based question. Topic: Elimination period. Mr. Davis has a long-term care (LTC) insurance policy with a 90-day elimination period. After being diagnosed with a chronic illness, he begins receiving home health care. How will the elimination period affect his benefits? A. He will receive benefits immediately once he begins receiving care. B. He must cover the cost of care himself for the first 90 days before his benefits begin. C. His benefits will only cover the first 90 days of care, after which he must pay out of pocket. D. He can choose to reduce the elimination period by paying an additional premium. Answer: B. He must cover the cost of care himself for the first 90 days before his benefits begin. Explanation: the elimination period is a waiting period during which the policyholder must pay for care out of pocket before the insurance benefits kick in. In this case, Mr. Davis will need to pay for the first 90 days of care. Option A is incorrect. The elimination period delays the start of benefits. Option C is incorrect. The elimination period does not limit the duration of benefits. Option D is misleading. The elimination period is set at the time of policy purchase and cannot typically be reduced later. Question 22. Topic: Policy non-forfeiture. What does the non-forfeiture provision in a long-term care (LTC) insurance policy provide? A guarantee that the policy cannot be cancelled for any reason. B. A return of premiums paid if the policyholder decides to cancel the policy. C. Reduced benefits if the policy lapses after a certain number of premium payments. D. Automatic inflation protection for the policy's benefits. Answer: C. Reduced benefits if the policy lapses after a certain number of premium payments. Explanation: a non-forfeiture provision ensures that if a policyholder stops paying premiums after a certain period, they will still receive reduced benefits instead of losing coverage entirely. Option A is incorrect because policies can still be cancelled for non-payment of premiums. Option B is misleading. A non-forfeiture does not necessarily result in a refund of premiums. Option D is incorrect as non-forfeiture does not provide automatic inflation protection. Question 23. Scenario-based question. Topic: Policy renewal. MS Larson has a long-term care (LTC) insurance policy that is guaranteed renewable. What does this guarantee mean for her policy? A. Her premiums will never increase for the lifetime of the policy. B. The insurer cannot cancel her policy as long as she continues to pay premiums. C. Her policy will automatically renew without her having to make premium payments. D. The insurer is obligated to offer her additional coverage options during each renewal. Answer: B. The insurer cannot cancel her policy as long as she continues to pay premiums. Explanation: a guaranteed renewable policy means the insurer cannot cancel the policy provided that MS Larson continues to pay her premiums on time. However, premiums can still be increased for an entire class of policyholders. Option A is incorrect because premiums may still rise though the policy cannot be cancelled. Option C is incorrect because premium payments must continue to keep the policy active. Option D is incorrect. A guaranteed renewability does not obligate the insurer to offer new coverage options. Question 24. Topic: Tax treatment. How are benefits from a tax-qualified long-term care (LTC) insurance policy typically treated for tax purposes? A. Benefits are considered taxable income. B. Benefits are tax-free as long as they are used for qualifying long-term care expenses. C. The policyholder must report a portion of the benefits as taxable income. D. The policyholder must pay taxes on the premiums they paid if they used the benefits. Answer: B. Benefits are tax-free as long as they are used for qualifying long-term care expenses. Explanation: for tax-qualified long-term care policies, benefits are generally tax-free if they are used to pay for qualified long-term care services. Option A is incorrect as benefits are usually not taxed. Option C is incorrect. The entire benefit amount is typically tax-free. Option D is incorrect. Premiums paid are not taxed and benefits used for care are also not taxed. Question 25. Scenario-based question. Topic: Home health care coverage. Mr. Blake has a long-term care (LTC) insurance policy that includes home health care coverage. After recovering from surgery, he needs assistance with daily activities. Which of the following is likely to be covered under his home health care benefits? A. Hospital stays during recovery. B. Skilled nursing care provided at his home. C. Prescription medications related to his surgery. D. Cosmetic surgery for scars from his surgery. Answer: B. Skilled nursing care provided at his home. Explanation: home health care coverage typically includes skilled nursing services provided at the policyholder's home. Option A is incorrect as hospital stays are not considered home care. Option C is incorrect because prescription drugs are usually covered under separate health insurance. Option D is irrelevant as cosmetic surgery is not typically covered under LTC insurance. Question 26. Topic: Assisted living facility coverage. Which of the following services is commonly covered by a long-term care (LTC) insurance policy when care is provided in an assisted living facility? A. Acute medical care. B. Custodial care for assistance with daily activities. C. Surgery for a pre-existing condition. D. Dental care services. Answer: B. Custodial care for assistance with daily activities. Explanation: Custodial care involves assistance with daily living activities such as bathing, dressing, and eating, which is a common service covered in assisted living facilities under LTC insurance. Option A is incorrect because LTC insurance generally does not cover acute medical care, which is covered by health insurance. Option C is not typically covered under LTC insurance. Option D is incorrect as dental services are not commonly included. Question 27. Scenario-based question. Topic: Eligibility for benefits. Ines Carter has a long-term care (LTC) insurance policy and is starting to experience difficulty with daily tasks like dressing and bathing. What criteria will her insurer likely use to determine her eligibility to start receiving benefits? A. The number of medical conditions she has been diagnosed with. B. The amount of time she has paid premiums. C. Her inability to perform a certain number of activities of daily living adults. D. Her age at the time she purchased the policy. Answer: C. Her inability to perform a certain number of activities of daily living adults. Explanation: LTC insurance benefits are often triggered by a policyholder's inability to perform a specified number of activities of daily living adults, such as dressing, bathing, and eating. Option A is incorrect as the number of medical conditions is not typically a deciding factor. Option B is irrelevant. The eligibility is based on functional ability rather than time paying premiums. Option D is not a factor in determining eligibility for benefits. Question 28. Topic: Inflation protection. What is the purpose of inflation protection in a long-term care (LTC) insurance policy? A. It guarantees that premium payments will decrease over time. B. It increases the daily benefit amount each year to keep up with the rising cost of care. C. It locks in the premium amount at the time of purchase, regardless of inflation. D. It provides coverage for medical inflation but not for non-medical services. Answer: B. It increases the daily benefit amount each year to keep up with the rising cost of care. Explanation: Inflation protection ensures that the benefits of an LTC insurance policy keep pace with the rising cost of long-term care services over time. Option A is incorrect as premiums do not decrease over time with inflation protection. Option C is incorrect because inflation protection focuses on increasing benefits, not locking in premiums. Option D is incorrect because inflation protection generally applies to all eligible long-term care services. Question 29. Scenario-based question. Topic: Benefit triggers. Mr. Anderson's long-term care LTC insurance policy includes cognitive impairment as a benefit trigger. After being diagnosed with Alzheimer's disease, how will this trigger affect his ability to receive benefits? A. He will be required to complete an elimination period before benefits begin. B. His cognitive impairment will automatically qualify him for benefits without the need to demonstrate functional limitations. C. He must wait until he can no longer perform any activities of daily living adults before receiving benefits. D. He will not be eligible for benefits unless he is also physically impaired. Answer: B. His cognitive impairment will automatically qualify him for benefits without the need to demonstrate functional limitations. Explanation: LTC policies that include cognitive impairment as a benefit trigger allow individuals with conditions like Alzheimer's disease to qualify for benefits even if they are still physically able to perform activities of daily living adults. Option A may apply, but cognitive impairment still triggers benefit eligibility. Option C is incorrect because cognitive impairment does not require an ability to perform adults. Option D is incorrect as cognitive impairment alone can qualify the individual for benefits. Question 30. Topic: Respite care. What does respite care typically provide in a long-term care (LTC) insurance policy? A. Emergency medical care for the policyholder. B. Short-term relief for family caregivers by providing temporary care for the policyholder. C. Financial assistance for unpaid medical bills. D. Full-time custodial care in a hospital setting. Answer: B. Short-term relief for family caregivers by providing temporary care for the policyholder. Explanation: Respite care is a benefit in LTC insurance that offers short-term care to give family caregivers a break from their caregiving responsibilities. Option A is incorrect because respite care does not involve emergency medical care. Option C is unrelated. It does not involve financial assistance for unpaid bills. Option D is incorrect because respite care is usually not full-time hospital care, but rather short-term relief for caregivers.